This is Matthew Kratter from Trader University, and today I want to talk about CPI inflation, the number which came in quite hot yesterday, as well as the Eth Merge, and what could happen tonight. So make sure you stay tuned for the entire video. So CPI numbers came in on the hot side of the market's expectations yesterday. The market was expecting actually a small month-over-month decrease in CPI. Instead, it came in at an increase of 0.1%. and year over year of 8.3%. The core prices, core CPI, which excludes food and energy, which are two of the things we can't live without, but this is how the government does statistics. Core CPI came in at 0.6% month over month, which the market really didn't like, and 6.3% year over year. I'm going to link to the BLS page that announced this so you can dig down if you want more details. If we take a look at CPI by category, though, we can see obviously energy and food increased quite a bit. All these categories at the top, from fuel oil to airline fare, gasoline, dairy, meats, poultry, eggs, etc. Down here, this yellow line is the general CPI itself, so we can see which items increased more than the index and which increased less than the index, things like used car and even rent, though rent was up quite a bit for a year over year number. This has been brutal inflation that has been caused by Fed policy, and now the Fed is trying to rein it in without completely killing risk asset markets. Now, the current Fed funds target, which is this very short-term overnight lending rate for banks, and this is set by the Fed. The current rate is, and it always trades in a range. The Fed tries to keep it in a range through open market operations. It's currently at 2.25% to 2.5%, but this hotter CPI number coming in basically ensured that there's a 100% chance that we get a 75 basis point hike, which would take us to 3 to 3.25% on the Fed funds target range. This is going to be the meeting on September 21st. If you're finding this video helpful so far, I just ask you to hit that subscribe button. So if we take a look at the probabilities, and these are probabilities implied by the Fed funds futures, we're looking at the meeting date, the Fed meeting date of September 21st. There's a 64% chance that they hike 75 basis points and get us to the 3 to 3.25% range. And now there's a 36% chance that they actually go a full percentage point. They hike 100 basis points to 3.25 to 3.5%. So there's still sort of 2/3 to 1/3 in terms of the probabilities, but the odds of a 50% basis point hike are off the table. We're basically pricing in a 100% chance of a hike above 3%. If we take a look at the 2-year note, I've given you this as a rough rule of thumb, that the 2-year note gives the Fed, along with a couple other factors, gives the Fed room to hike and sort of puts a ceiling on where they can hike. And what we've been having is the 2-year note move higher and basically give the Fed a little bit more wiggle room as the Fed has continued to go higher. And so we're at new highs for this move on the 2-year note yield. This is the 2-year note Treasury. It's currently at 3.81%. So we can see that if the Fed, even if they went a whole 100 basis points, a whole percentage point, and got to 3.25 to 3.5%, they'd still be below the 2-year note. Now, it's a question of how long and how far this can continue without causing a huge market dislocation, either in risk assets like stocks or in the Treasury market itself and in the other financial plumbing in the money markets and repo and all these different things that the Fed is taking a look at. And so we'll continue to see how that plays out. In terms of the dollar, if we look at the dollar index, which is mostly just the dollar versus the euro and the yen, we can see that it did not hit a new high for this move, but still hovering close to 110. If we take a look at where interest rates moved yesterday on the CPI announcement, the bulk of the move was at the front of the curve at the one year level and the 2-year level in terms of maturities. The 2-year moving from 3.58 to 3.75, and it has since moved, as we saw, higher this morning. These are sort of settlement prices, but the 10-year note did not move up that much in yield. It just moved up 5 basis points. And what this means is we got a deeper inversion in terms of the yield curve, where now the 2 years trading even higher than the 10-year than it was before CPI, though again, we haven't hit the lows in terms of the yield curve inversion that we saw at the beginning of August. But the yield curve 2s and 10s are currently inverted 35 basis points. An inverted yield curve, normally yield curve should be sloping upwards from the left to the right. An inverted yield curve is a sure sign that the Fed has hiked too far. And so we have this sort of conflicting things in the bond market, where the 2-year note is basically saying you have a little bit more room to hike Fed. But the fact that if we look at the whole yield curve and that it's this inverted, this makes it very difficult for banks to make money. And it shows basically that the Fed has hiked past the natural growth rate and natural inflation rate of the economy. So if we use the 10-year note as sort of this proxy for inflation and growth, and we use the 2-year note as a proxy, as we've said, for Fed policy over the next 2 years, when the 2-year note gets above or sufficiently above the 10-year note, and it really should not be above it, because you shouldn't get paid more to lock up your money for 2 years than for 10 years. But what this shows is that the Fed is already extremely tight relative to the economic potential of the economy. So for all of these reasons, I still believe that the bottom is in for stocks and Bitcoin. Of course, the markets can make prognosticators like me look like fools very, very quickly. But I do think we did see those capitulation lows in late June, both for the S&P, for the general stock market, and the NASDAQ, as well as Bitcoin. And it's important to realize and remember that government economic data is notoriously noisy and volatile, especially inflation data. So we could see much, much weaker inflation data in terms of lower inflation data in October, and this would definitely make the Fed's job easier. They don't want to cause any sort of crash going into the midterms, and it still would appear that the bulk of their work will be done by the end of the September meeting. Though if we look at Fed funds, they are pricing in another hike on November 2nd. So you have the next meeting, which just a few days before the midterms, 21% chance that you hike. What would that be? Well, it really depends on what they do in September, but 21% chance that the new Fed funds range is 3.5 to 3.75%, and then a 55% chance that it's at 3.75 to 4%. What we're basically seeing here is the market is, the stock market and Bitcoin, for example, are comfortable with these numbers. In other words, this is being priced in to Fed funds futures, and the market is basically pricing in, for example, risk assets like stocks and Bitcoin are pricing in these probabilities as well. So again, the Fed has already hiked us into a recession. It's very important to recognize that and remember that, and that this has been priced into the market already, with risk assets down sharply, even bonds down, which are normally a pretty safe place to hide out during a recession, and 2s and 10s inverted, the yield curve inverted at many different points in the yield curve. And so this suggests that the Fed cannot do much more in spite of what the 2-year note is telling us. I expect economic numbers to continue to worsen from this point on, and CPI inflation will continue to come down year over year. We have seen it come down off the June peaks, and this may be one reason that the stock market has bottomed. If we take a look at it just over the past year or so, we can see the peak was close to 9% in June, and CPI inflation has actually come off since then, and I would expect this trend line to continue lower. In terms of what's coming up for Bitcoin and other events, there is one wild card for Bitcoin in the next 24 hours, and that's obviously the Eth Merge, which we're going to be watching very closely. This is the ETH's transition, as we've been talking about for months and months, their transition from proof of work, which is a very good consensus system, to proof of stake, which is a very bad, weak consensus system that's very easy for regulatory capture. But we will be watching this. This is a technical feat, and I honestly have no idea which way it's going to go. It would probably go smoothly if I had to bet money, but I think there is a small chance that something goes wrong. Currently scheduled for Wednesday, September 14th at 11:56 p.m., so 17, almost 18 hours from now. And I would say if something goes catastrophically wrong with the Eth Merge, and I'm not expecting this, Bitcoin could, of course, tank. I think it's highly unlikely, but not a 0% probability. And so for these reasons, I put in some Bitcoin limit orders at 15K and 10K, which are levels I don't expect us otherwise to hit ever again. But in case you get some sort of short-term technical breakdown and panic in Ethereum and it spills over to this other coins in the space. Obviously, Bitcoin is a unique asset, but over the short term, it does trade with these other assets which are completely different, things like Ethereum and Cardano, etc. If we were to fall down to these sort of unthinkable levels of 15,000 or 10,000 on Bitcoin, I don't think we stay down there for more than a couple hours, maybe even just a couple of minutes. You get sort of a spike bottom if it even happens. So I don't expect that to happen, but I think it's a nice opportunity to possibly pick up some really cheap sats if we do get a short-term technical breakdown. It's very strange actually how the market, this should be market, how the market can't figure out how to value Bitcoin versus ETH. And I'll give you an amazing example of that. I've been following this throughout the year, and you can watch it trade this way. But basically, if we take a look at year-to-date returns on Bitcoin and Ethereum, Bitcoin down 57.41%, Ethereum down 57.51%. So they basically move the exact same amount in spite of all the volatility, and one falling one day, one falling the other day. They're basically down the exact same amount for the year, with Ethereum being priced down slightly more, just 10 basis points more. But this again shows you how early we are, how the general market does not understand how to price Bitcoin versus Ethereum. And what the market's doing is just seeing the Fed hiking and Fed hawkishness and saying crypto bad, and so let's sell off Bitcoin and Ethereum to roughly the same amounts. But it'll be very, very interesting to see how these returns move in the coming days and weeks after the merge, if it in fact happens, which I do. I expect it to happen. I expect it to go smoothly at a technical level, and we'll talk more about that tomorrow. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks all for watching, and I'll see you in the next video.